The economic outlook for 2022 and 2023 is good, though inflation will remain high and then storm clouds will gather later on. I'm Dr. Bill Connerly. I connect the dots between the economy and business. I'm recording this in early March 2022 while the Ukraine war rages and the outlook is uncertain. I don't think that war will affect the American economy too much, so long as it does not turn into World War III, which I think is unlikely. A reporter called me last month and says, "Hey, Connerly, what economic statistic should business leaders be following in 2022? Well, it's not an economic statistic, it's COVID. In order to make a forecast, I had to make a working assumption. I believe that the disease will have less of an economic impact this year and on into later years. People have gotten vaccinations. They've gotten immunity from past infections. We have better treatment. So I'm assuming fewer deaths, fewer hospitalizations, and people will go out to eat in restaurants. They'll travel. They'll go to concerts. It won't be quite normal, but we will be moving in that direction. So economic growth, I think, is going to be very strong because of past stimulus. I don't think we'll get a big $1 trillion stimulus package approved in 2022, but stimulus, both fiscal policy and monetary policy, work with time lags. So I'm really looking backwards at what Congress and the Federal Reserve did when I make a 2022 forecast. But supply constraints will limit our growth. My GDP forecast, that's inflation-adjusted output of the economy, I've got growth at 4% this year and 4.5% in 2023. It could be higher if it were not for those supply constraints. Now, the supply constraints are easing. Most of our supply issues have been labor issues, but people are clearly going back to work. It has been a longer time since we had stimulus payments allowing people not to work, longer time since the extra unemployment insurance. The schools are open more reliably, so people are going back to work, and the production and shipping issues are slowly easing. I'm an optimist on supply, but not an overnight optimist. I'm a gradual optimist on this. And with all of the stimulus we've had, inflation will remain high. The Federal Reserve thinks that our inflation is mostly a supply problem. I think that sometime this year they're going to say, Bill Connerly was right. We have put in too much stimulus relative to our productive capacity. So I've got inflation in my forecast 6.5% in 2022, tapering down just a little bit to 6%. The Federal Reserve will eventually tighten as they come to accept that they have been too stimulus. I believe that short-term interest rates will move from right now about 0 to 2%. Long-term interest rates will also rise. That's a little more complicated. The global interest rates will go up as global demand for credit increases more than a global supply of savings. And then the premium that the U.S. has to pay will increase because of inflation. And also the Federal Reserve will stop buying Treasury securities and mortgage-backed securities, start shrinking their assets, and that will have a contractionary effect on the economy. So I put long-term Treasury bonds at 4% the end of 2023 and mortgage rates up at 5.5%. Now, a lot of people hear 5.5% mortgage rates, that's scary, but relative to historical patterns, we will still be in a very low interest rate environment. After 2023, things get a little dicier, and that's when I get nervous, and I get nervous because of time lags. You see, monetary policy does not work immediately. There's about a 1-year delay from action to effect in terms of employment, and then a 2-year delay from when the Fed takes actions until we get a change in inflation. This is a simplification. It's a distributed lag, and there'll be some effects after a couple of quarters rising to a peak and then tapering off. But that means that the Federal Reserve is going to be in a difficult challenge because of these time lags. When the Fed tightens, and they'll be raising rates, I think, later in March of 2022, when the Fed tightens, the first thing that happens is nothing. Because of the time lags, there's no immediate effect, except there will be probably an article in the New York Times saying monetary policy is no longer effective. There always is. But then the economy will slow down as measured by employment, but inflation has not yet worked through its longer time lag. And then what will the Fed do when they're seeing a negative effect on employment, but inflation is still high? People will call it stagflation. The Fed, one course of action is to continue fighting inflation. We will be at risk of a mild recession if that happens. The other possibility is the Fed has tapped the brakes. They get bad news on employment, but they have not brought inflation down. They get scared about job losses and they hit the gas again. This is the kind of mistake that the Fed made repeatedly in the 1970s. Now, they learned a lot of lessons in the 1970s, so there's good reason to think that they may be more reasonable. But they have a mandate, a dual mandate, they call it, not only to keep inflation low, but to keep the job market high. And the Federal Reserve really likes today's job market when a high school dropout with a prison record is able to find work. So they will be very nervous about tightening. I'm not sure what path will come, but I think that we are at greater risk, looking at 2024 and beyond, at greater risk of a recession. It's like driving on an icy road. If you're keeping the car straight, everything looks good. But once you start to swerve, man, you're at great risk of a crash. And I think that applies to us. So one of the things we economists know about inflation and economic growth is that economies with low inflation tend to have stable economic growth. Low inflation, stable growth. Take a look at the decade before the pandemic. For 10 years, we had growth rates a little bit higher, a little bit lower, but no recession over a 10-year period. What would this have looked like if, instead of the 2% inflation that we had, suppose inflation were much higher? We've actually run that experiment. We ran it from 1973 through 1982. And with high inflation, the economy went up. It went down. It went up. It went down. And I'm afraid we are getting into that kind of boom-bust cycle. And it's different from what today's business leaders have experienced. Relative to the experience of most of you watching this video, the future booms will be boomier and busts will be bustier. Booms will be boomier and busts will be bustier. I wasn't sure if that last one was really a word. Typed it into Google. Lost 2 hours of productivity. So the business leader must be wondering, what do I do in such an uncertain environment? Well, I've got a book on that subject, The Flexible Stance, Thriving in a Boom-Bust Economy, telling you what to do about your business if you don't trust the economist's forecast. So the summary is good growth in 2022 and 2023, still with high inflation, interest rates rising, and look for a swerving economy in 2024 and beyond. I'm Dr. Bill Connerly. I connect the dots between the economy and business, and I put out a monthly newsletter that you're free to subscribe to. Just text the word econ to 42823. And thanks for watching.